I'm Frederick Bell, the CEO of Elemental Royalties, and we are a gold-focused royalty company that listed in Canada in the middle of 2020. And our key differentiator is that right from the outset, we have high-quality, cash-flowing royalties that make up 80% plus of our portfolio.
Fred, how are you? Good to see you. Been a while.
Very good, thanks. Yeah, we're probably sitting within sort of 5 kilometers of each other.
We are. But it's safer this way, Fred. It's safer this way. Hey, well, look, thanks for that intro, and good to see you again. Saw some news come out today. Some good news, actually, because I think it's one of your bigger royalties. You want to tell us a little bit about it?
Yes, it's the biggest royalty we have, and we acquired it as part of the South 32 acquisition that closed in early 2021. And it is a 2% royalty on Australia's newest gold mine, Karlawinda mine in Western Australia, operated by Capricorn. And really, really important de-risking event for us is they've been building this mine over the past year, and they just had first gold pour at the end of June. And so coming into Q3, they'll be ramping up and bringing the mine up to full production rate. And that's absolutely key for us, because it's that mine on a full year basis almost doubles our royalty revenue single-handedly. So to see that come in on time, on budget, despite COVID, it's really encouraging, and look forward to further announcements from them over the course of the next couple of months.
Fantastic. So what does that actually mean in dollar terms for your cash and cash situation?
So on an annualized basis, it's about $4 to $4.5 million in royalty revenue to Elemental. And for perspective, we announced $5.1 million, which was in 2020 of gross revenue. And so to have Karlawinda coming on in the next sort of month or two in a serious way, that's the biggest catalyst so far, and it will be our biggest royalty, going forwards. And a bit like our Wang Yong royalty, a 10+ year reserve life, it's really important, because it doesn't just add extra revenue, but it adds extra revenue with a long runway ahead of it, and also with a tier 1 jurisdiction in Western Australia, which is something our portfolio didn't have as much for before.
Okay, so let's talk about some of the other numbers involved. You talk about it like a long runway. So it's currently 10-year life of mine. What else do you know? Because obviously Capricorn put out an announcement themselves last week. What else do you know in terms of their intent on this, in terms of the current resource reserve numbers, the exploration budget, etc.?
So Capricorn have said they're putting out a new reserve and resource statement in Q3. And so with the mine just having come on stream and going straight into an updated resource and reserve is really encouraging from our perspective. And they put out a few exploration results in the first half of the year, which is really near mine drilling that they've done. And from our perspective, I think that's really encouraging. They did the original pitch shell for this at about $1,200 gold equivalent. And I think there's some scope there for them to maybe optimize that and actually increase the resource that's there and what's mined. And from us as a royalty holder, obviously, we always like to see exploration going on. We always like to see new resources and reserves coming in, and never more so than when it's an operating asset, because that is materially de-risked. You can go to your exploration project and add 100,000 ounces. It still has to get over the hurdle of building the mine. When you've got an operating asset with all the capital invested and they add an extra 100,000 ounces, there is a really high likelihood that you will be seeing revenue from that down the line.
Right. So this is a fairly big plan. I mean, how much scale has this got ahead of it? Can they increase the size? Because it's already quite big, right? So what are they going to do about that? Can they finance that out of?
It's a really large, relatively low grade, about 1 gram a ton deposit. And so what they've actually done over the last 18 months is they've optimized the mining plan, which has meant increasing the throughput. So it's guided for about 4.25 million tons per annum, which is really big by gold mine standards. And I think from our perspective, it's actually one of the benefits is with size and scale. It kind of sometimes blends out variances in the grade. So you often see in gold mines, you can have quite variable production quarter to quarter, depending on where they are in the resource. And I think in with Karlawinda, what we've got a very large lower grade resource, which is going through the mill at a really high run rate. And that for us should give us a more steady royalty revenue going forwards, quarter to quarter and year to year.
So let's just again remind people, when you've got a royalty over something, it's a royalty over very specific assets. So if they do this upgrade to the resource reserves, your royalty still covers that, does it?
Yeah, so the royalty at Karlawinda covers all of the existing resources and reserves. The foreseeable any additions and exploration has really been done, I think, within a very small area around the existing pit. And that's something that, again, probably important to touch on, but a lot of the mines you're seeing coming on in Australia, probably not dissimilar to Canada, are sort of redevelopments of old mines from maybe the 1990s, early 2000s that were put on care and maintenance. And this is a new mine. And so in terms of exploration, there has been a lot less exploration done regionally around this than there would have been had it been an old brownfields mine. And so from our perspective as a royalty holder, there's a lot more exploration yet to be done, which always gives you more optionality. As always, you focus on building the mine, you get it up and running, you've got that 10-year plus reserve life. And then once you've got the mine going, you go into the exploration, and then you can really start adding to it. And I think that's what we'll see over the coming year or two at Karlawinda.
Okay, and have they given guidance on the budget for exploration?
No, so I think they put some drilling numbers out. So I think they did about 7,000 meters over the course of Q1 and Q2 on near pit drilling, but they haven't guided by budget. So we just know that there will be an updated resource and reserve in Q3. Okay,
Karlawinda, sounds good. Royalty on all of the land package and assets, good. What else is going on? What in terms of exploration on some of your other royalties that you have? Maybe just again remind the audience in terms of what the near-term revenue is.
Yeah, so it's I think some of our royalty operators give more detail than others, and some guide by revenue and some by meters drilled. At Karlawinda, they've guided, as I said, to the resource and reserve update. Our second royalty, really, the Wangyon royalty, which did about 175,000 ounces in 2020, with now Endeavour Mining as the operator. They guided by budget for this year. So I think about $12 million budget for exploration there. And that mine only came on stream at the end of 2019. So again, pretty early on in terms of exploration, and great to see them going that aggressively, I think, for it. And Endeavour now are a top 10 gold miner globally. And that is the second biggest budget they have in their portfolio. So over the course of 2021, we should be getting some pretty good updates coming out of Wangyon on the exploration side, which is really encouraging. And then a couple of other royalties down in Kaya in Chile. We actually, I think, have put out 2 exploration updates from there over the first half of the year. And that's, narrow, high-grade underground veins. So that typically requires quite a lot of exploration to define and delineate. And they had some really good hits in the first half of the year, which I think is really encouraging because there hasn't been a lot of historical exploration there. That resource was brought on to keep their existing mine nearby going. And so they sort of, in a way, brought it into production as quickly as possible. And a lot of the exploration, I think, and potential is still to be defined. So really good to see them progressing that. Focus, one of our other royalties we acquired from South 32, Laverton in Australia, they will have an updated reserve and resource statement at part of the deposit this year as well. And so that is, I think, 3 or 4 of our sort of, really material royalties that by the end of 2021 should be coming out with updated resource statements. And I think that's, it's much easier for us to demonstrate the value and the upside once you've got some of these updates coming out, and you can point to the fact that 1 million ounces went to 1.2 million ounces. And if you can do that continually year on year, it really shows the value in the portfolio. And so I think by the end of 2021, having a few of those that we can demonstrate would be really helpful.
Okay, well, I guess what I'm keen to understand is, how you're building this company up, where you think you sit in the marketplace. If I look at 2021, you've got about 6 months of Karlawinda revenues in there potentially. So you're $6.5–7 million. You're going to have 12 months of Karlawinda next year, and what, a little bit more from the other projects. I mean, what's the number for next year and 2024?
We have almost a year from today. So the end of July in 2022, our royalty on Equinox Gold's Mercedes mine, that starts paying us. And so that royalty just had a clause in it that it only pays from a certain date. And so in about a year's time, that royalty, and it's a 1% royalty on that mine, starts paying us. So we have Karlawinda to come on now, just had first gold pour. In about a year's time, and we have Mercedes that comes on stream. And that organic growth profile, that I think is really what we sort of bought into with the South 32 acquisition. And I think over the next sort of three months or 3 or 4 months, we'll start to see that kick in with Karlawinda reaching commercial production. And for us, when we set out to build Elemental, one of the things we thought about was creating that. We know we're going to have upside. We're a royalty company that's been able to double our revenue year on year, and we see a long runway ahead of us in terms of royalties and opportunities. But the challenge is always, what is the downside? And so when we set Elemental up, our objective was, if we can get towards and it was always a sort of $10 million revenue number. If we can get to that from a portfolio of diversified royalties, then it really covers us on the downside. Because even if things go wrong, even if COVID happens and one of your mines produces less, we will be cash flowing and we'll be cash flow positive. And that gives us a degree of independence from the market and a degree of control on when we raise money. And so for us, the holy grail in the royalty space is producing royalties. And if we can do the hardest part first and tick those boxes, then it gives us the best possible platform to grow the company. And I can tell you from experience, for every one producing royalty we have seen, we probably see 20 or 30 exploration development royalties. And so to get those royalties from the outset, I think is the hardest thing to do. And if you can do that and add value at the same time, you give yourself the best possible chance of success. And it also really differentiates us in the marketplace. And you said, where do we sit in the marketplace vis-a-vis other royalty companies? And if you look at the sort of sub-$1 billion royalty space, you can get access to a lot of royalty companies with exploration and development assets. There's probably 10 or so royalty companies that fit that mold. You can't get many royalty companies that are our size. In fact, you can't get any and have the revenue that we have. And if you were looking at $10 million plus royalty revenue, you'd be looking 500 mil market cap and above. And we're a 100 million market cap company that's going to be ticking that box from Q3 onwards. And so that is straight away a really, really big difference and a really, really big de-risking event. And if you think that producing royalties normally trade at a premium, and we're currently trading at 1 times NAV, I think it highlights the opportunity there, both for us, but also as management, but also for shareholders, looking for a good entry point.
Do you know what's better than that? Being debt-free.
Yeah, yes. And that's a very good segue into
I thought about it.
Into the Sprott loan we took from Sprott Resource Lending when we closed the South 32 acquisition. And for everyone's background, this is the second time we've taken a loan with Sprott Lending. The first time was when we bought the Wagnon royalty at the start of 2020, and we had it for about 7 months, and we repaid it when we listed the company. And when we did the South 32 deal that closed in early 2021, we took a expanded $25 million credit facility with Sprott Lending, and that was I think it was a sign of our maturity as a company being able to access that. But it was, I think, from our perspective, it's a 9 plus 1% interest rate, and so it's great to be able to get that, but it's also expensive, relatively speaking. And one of our key objectives for the company moving forwards, and something that we thought we would be able to achieve, is actually refinancing that credit facility and getting a better rate with potentially some of the bigger Canadian banks. And if we can do that in the second half of the year, I think again it really ticks a box in terms of differentiation. And most junior royalty companies couldn't get a loan at 10%. And if we're graduating from that to something at 5%, and we're going up to $10 million plus of revenue, all of a sudden you're looking at Elemental and you're going, well, they look much more like a mid-tier royalty company than a junior royalty company. And they're, at the moment, they're one of the cheapest on an absolute basis royalty stocks out there. So that's really key. And for us, Karlawinda is probably the key that unlocks that opportunity, because it's not just almost doubling our revenue, it's almost doubling our revenue in a tier 1 jurisdiction, which of course gives lenders a lot of comfort. And so it was sort of one of the objectives that we want to achieve post the South32 acquisition. And again, I think will be a really important catalyst for us if we can achieve it in the second half of this year.
Okay, you're talking a lot there about the size of company that was certainly the valuation for a company doing 10 million revenue. So that's a kind of a benchmark for you. When you hit that, you think that you should start seeing, or start getting credit for that achievement and get a re-rate. Okay.
Yes.
I was going to sort of, when I want to bring in these recent ELE deal. Okay, the transaction there. I mean, do you think that was well priced? Do you think it was a fair price? Is that reflective of the sorts of numbers that you think you should get, or should you be doing better than that?
Well, there's clearly at the moment in the last year there's another group of new royalty companies that have come on, and everyone is chasing growth. It's a very scalable business model, and there are a lot of benefits that come with scale. And I think the two characteristics, the two really boxes that royalty companies want to tick if they're growing successfully are quality assets and revenue. And that's really what everyone wants to add and to build their portfolio with. And I think ELE, it has some good quality assets in there, and it had some revenue as well. And so, clearly that was an acquisition that they thought made sense both for ELE and for Gold Royalty Corp. But it's interesting because I think Elemental had almost double the revenue that ELE did last year. I think we would have had more than double the revenue that they were sort of targeting this year. And we have some really good quality assets with Karlawinda just coming on. And when you think that we're at 100 million Canadian dollar valuation and that deal was just done at a 300 million dollar Canadian valuation, I think it gives you an idea of I think the value opportunity in Elemental at the moment. And if I looked at us superficially from the outside, I might not see much that's different from the end of last year. But actually, when you look forward and you say that, oh, hang on a minute, their biggest royalty is just about to come in. It's not reflected in their numbers yet. It's certainly not reflected in the valuation. And that's before Premier Gold comes in. It's before you attribute any value on any of the other assets. I think it's probably the best time to enter since we listed the company in terms of value for the assets that we have. And I think that, even without that recent M&A deal on ELE, and even without some of the newer entrants, I think it was apparent. But I think those really highlight the value that is in our portfolio. And I think it'll be interesting to see what happens in the royalty space over the next year or two. It's always been a model that benefits from scale and it benefits from critical mass.
Well, let me come at that another way, your argument another way. Okay, because it's one data point. Okay, it's a transaction, so it says, if the market will pay it, it'll pay it. But you've got one individual or one group, you thought it was worth that amount. What other data points are you using to work out what you could be worth? Because you could argue they overpaid. You could argue that. I think some people said it to you when you did South32, right? So you could argue that. So what else are you looking at to say, do you know what? Even if it was slightly more than perhaps the rest of the market wanted to pay, there's still enough data out there which leads us to believe that we're doing this right, and we will get to where we want to get, and we can be better valued going down the line. What are you looking at?
I think it's first of all, it's obviously what are the underlying assets and what is the ballpark valuation on that. And to do that valuation exercise, you'd want to see kind of discounted cash flow on the key assets. What is the revenue it's producing? That's sort of probably a second one. But then around the assets, you're also looking at track record, management, ability to add value, ability to access capital markets, liquidity, a lot of those things, some of which are more intangible. And so it may be in this scenario, in this case that you just used, it may be that there are a number of intangibles that they believe will sort of, I suppose, make the pie bigger for everyone and add that. And I know that from our perspective, if you were looking for a royalty company with material revenue, there is no one else that gets even close to Elemental. And that's where we are today, even without anything over the next year. And it's ignoring our track record over the past couple of years. And if you actually take a 30,000 foot view of the royalty space, in the last decade, there has not been a startup royalty company that has gone from $0 to $10 million of revenue a year. There isn't one. There have been some that have come in with portfolios from majors and from others, but no one has done it from a standing start. And actually from Q3, Q4 this year, that's what Elemental will have achieved. And I think we would have done it in a really intelligent way, where we are trying to minimize the risk at every step by diversifying our royalty revenue and by having a really well-balanced portfolio. And I think, if you took our individual assets out and auctioned them in a marketplace, I think you'd get a higher valuation than where we sit today.
A lot of M&A talk going on at the moment. We just talked about one transaction there. Are you in the market to do more M&A? You've done South32. Okay, it's good. Are you in the market to do more than that? And in fact, here's one for you. Did you get shown the ELE deal beforehand? Would you have done it if you could?
Well, we've known Trey and ELE management team for a few years, going back to when we were private. So I think that obviously that was a transaction that they felt made sense for them in terms of adding value for their shareholders and being part of a bigger company. One of the differences between ELE and Elemental is that we haven't actually been listed for a year even yet. And ELE have been building that over quite a lot of years, to get to this point. And so for us, where we sit today, we see the potential to double to triple the valuation over the coming years. And we think that that's easier to do as a 100 million market cap company than it is to do as a $500 million, billion dollar market cap company. So we're not against, mergers and acquisitions and adding scale where it can really add value for shareholders. But at the moment, it would be difficult for us, if we really do represent the best value, it would be difficult for us, unless there was a really compelling justification and reason to go and become part of a bigger vehicle where actually it might be harder to grow and add value. And so I think Elemental, we sort of did a lot of work to build the company to where it was, to do the hardest part, which is producing royalties. And I think that the South32 acquisition that only closed at the beginning of this year, that the benefits of that really kick in over the course of this year. And so I think it's always a conversation that we can have, and we know all the other royalty companies in the space. But I think for the moment, our view is that the best way to add value is by doing some really smart deals for Elemental that add add quality, add more diversification, add revenue. And if we can do that, then that's the quickest way to give our shareholders value.
So using that logic, should you have done South32?
Yeah, I think it's a key, when you're trying to build a royalty company, and we said this when we listed the company, it's a combination of value and scale. And when we had built the company privately, we had done an awful lot of value deals. So those are royalties where I think, it was really clear, compelling value that was added. And when we listed, one of the, I think, sort of feedbacks, we got, particularly for bigger investors, was scale is also important. Because if your costs every year are $1 million and you have $2 million of revenue, you have $1 million of free cash flow. But if you take that $2 million of revenue and go to $10 million of revenue, maybe you've got, instead of $1 million cash flow, you've got 9 million. And so you really get the benefits of scale in the royalty model because your sort of operating costs are relatively stable. And that's why, for us, a combination of doing those opportunistic deals and doing some that really add value and scale, I think that is a potent combination that will give us the best value. And when you look at something like being able to put in place a credit facility, again, the big banks don't do that for less than tens of millions. And so it's all very well, adding a lot of value as a very small company, but actually it can be quite difficult to grow. And if you can, in our position, if you can have access to a credit facility and a very attractive rate cost of capital, and if you can have some really good assets in the portfolio that are cash flowing, we know there are an awful lot of opportunities out there in the exploration development phase that we can go after in due course. But we would like to do that as much as possible, being able to use cash flow, having access to capital at a really attractive rate. And that's something that other people haven't had and haven't been able to do because it's the hardest way of doing it. It does require a more patient approach. But I mean, our view is it will pay off in the medium and long run.